Tired of dropping your phone or struggling to prop it up? Meet the Pop Sockets phone grip with expanding kickstand in black, your new must-have accessory. Don't miss out. Grab yours today. Click the link in the video description to shop now on Amazon.
Hello and welcome back to Voro. I'm your host today, and we're diving into the world of stocks with a fascinating story about the Dow Jones. So, you might be wondering why the Dow Jones has been on a roll since April this year, consistently setting new highs after surpassing its previous peak. Well, it's not just a fluke, folks. The uptrend structure remains intact, driven by monetary policy, real economic conditions, and corporate earnings quality all aligning in a more favorable direction. Now, let's talk about the recent FOMC meeting on September 18th. The Fed initiated its first step toward monetary easing with a 25 basis point rate cut while keeping its data-dependent message intact. That might sound like semantics, but it has two key effects on the index. Borrowing costs have peaked, allowing financial conditions to loosen and support valuations, and aggressive rate cuts are no longer expected. So, what does this mean for the Dow? Well, as we all know, it's heavily weighted toward cyclical and value stocks. When real interest rates decline while growth remains positive, these stocks tend to benefit. And that's exactly what we're seeing right now. Recent economic data suggests a mixed performance across sectors without tipping into recession. Manufacturing and services PMIs have softened, but housing has shown resilience with new home sales surpassing expectations. Now the key question is, what's next? The Fed will release some critical data this week, including GDP, weekly jobless claims, and especially the core PCE price index. The base case remains that growth stays moderately positive while inflation continues its downward trend, allowing real yields to stabilize or decline. This means support for equities will remain. And let's not forget EPS. Given the sectoral composition of companies within the Dow Jones, profit margins could improve as capital costs decline and expense management tightens, particularly in industrials, consumer staples, and interest rate-sensitive financial services. Any signals reinforcing expectations of a monetary policy pivot toward easing are likely to have a direct and positive impact on equities. Now I know what you're thinking. Voro, what about the risks? Well, there are two main concerns. First, expectations of easing could be delayed if inflation proves persistent or the labor market reheats, driving real yields and the USD higher, which can pressure cyclical equities in the short term. Second, geopolitical risks and trade policy uncertainties could prompt markets to shift back into a more defensive stance, especially after a prolonged rally. But here's the thing. Voro is all about staying ahead of the curve. And based on the data we've seen so far, I believe the medium-term outlook for the Dow Jones remains tilted toward the positive. The combination of buybacks, steady dividends, and relatively attractive valuations compared to growth-heavy tech stocks is a structural advantage for the Dow's sectoral composition. So, what does that mean? It means Voro's members can expect continued upside potential from this uptrend. But remember, no one said it would be easy. Markets are at a pivotal stage, with upcoming data providing crucial clues for the Fed's next moves. Any signals that inflation remains sticky, while economic data accelerates could push rate cut expectations further out, or renewed geopolitical flare-ups could trigger a meaningful correction in the Dow before it regains momentum. That's the world of stocks in a nutshell, folks. Stay informed with Voro, and I'll catch you all in the next video.